From the campus of Yale University, this is Business Talk with Jim Campbell, nationally syndicated across the country on the Biz Talk Radio Network and coming to you from our flagship stations, Yale Radio WYBC and 1490 AM WGCH Greenwich. All talk and all business, 60 minutes of radio with leading figures from the world of business along with the business of politics and sports. Inside the biggest insider trading scandal in history on the quest to bring down the most wanted man on Wall Street. That's today on Business Talk with Jim Campbell. Sheelah Kolhatkar left the hedge fund world where she was an analyst to join the enemy, as President Trump would refer to it, the media. She's now a staff writer at the New Yorker magazine, where she writes about Wall Street, Silicon Valley, and politics. Sheilah's new bestseller, which is a mesmerizing crime story as well, Black Edge, Inside Information, Dirty Money, and the quest to bring down the most wanted man on Wall Street. Welcome, Sheelah.
Great to be here.
Great to have you. Now, you were taking on a case involving the biggest fish on Wall Street, Stevie Cohen, to an extent. Did you have any trepidation about doing that? Because there's a certain amount of fear in taking him on. Wall Street firms, for instance, never even stopped doing business with him.
Of course, I was a little nervous about it and just daunted by how difficult the whole thing seemed. I first really became interested in this story at the very end of 2012, early 2013, when there was a lot of sort of anticipation in the legal world about Steve Cohen. The government had been investigating insider trading for several years. And one day, this was in November of 2012, the FBI went down to Florida and arrested one of Steve Cohen's former employees. It was a very dramatic moment. They sort of dragged him out of his house in handcuffs. And, of course, it was intimidating. The subject is a tough one for a reporter, but I was so intrigued because it seemed really clear at that moment that the government was gearing up to kind of go after Steve Cohen himself, one of the most powerful people in the financial world. And I just knew that was going to be a really interesting, rich story, but also an important one. And I tried to just put my fears aside and kind of dive in.
All right. Before we go farther, I want to read a piece of the Southern District of New York's sort of indictment when they went after SAC, the business itself. The indictment charges the management of a major hedge fund with criminal responsibility for insider trading offenses committed by numerous employees, made possible by institutional practices that encourage the widespread solicitation and use of illegal inside information, and an institutional indifference to unlawful conduct, resulting in insider trading that was substantial, pervasive, and on a scale without known precedent in the hedge fund industry. That's pretty brutal, isn't it?
Yes, that was sweeping language, and it was a remarkable indictment because it came at the end of this multi-year investigation, and there had been all this drama built up around the question of whether they would charge Steve Cohen himself. They had linked multiple former and even one current employees of Cohen's with insider trading. They had evidence kind of connecting him in some cases to it. They had two guys about to go to trial for insider trading that they were allegedly responsible for doing at SAC. But when this all kind of came to a head in the summer of 2013, Steve Cohen's lawyers went down to the Southern District and made this big presentation for all the prosecutors. They were there for 4 hours. They gave out these binders, and they tried to persuade them not to charge Cohen. And their argument really boiled down to the fact that they said, you just don't have a witness who will take the stand and testify against Steve Cohen, and that was true. And the prosecutors had to go back to their offices and kind of debate and wring their hands about what to do. And the whole world was watching to see if Cohen was going to get charged. And in the end, they charged the company, which was still a kind of a big deal. But it left many people unsatisfied because Cohen himself, his life was really barely disrupted by
Yes,
this.
and we should say that they shut down SAC Capital and it had become a family office where you couldn't take outside money, which is known as Point 72 Asset Management. It's a great credit to your book that it reads like a mesmerizing, thriller, even though people know the ending. The government ultimately unsuccessful in taking him down personally. I know you're a media person, so you might not want to answer this, but is there any doubt in your mind that he was personally culpable, Steve Cohen, for insider trading?
Well, that is of course a very key question. Listen, I don't know the answer. I was not in his mind, and I cannot speak to what his knowledge or intent was at any given moment. I mean, I can tell you, having immersed myself in all this evidence for a long time, it certainly seems that he should have known what was going on at his firm. He's a very smart guy. He was, and I'm sure still is, a very rapacious consumer of information. He was sort of a micromanager. He really wanted to know everything that all his traders were doing. He got very angry if people didn't share their trading ideas with him. And he was just controlling, so it's hard to believe that he would really just be oblivious to what was going on under his own nose.
Tell folks.
So that's the most I can really say. I mean, it just sort of looks bad on paper.
I think you've said more than I expected. So what is how would you define black edge for people that don't know what that means?
So, the first thing you need to understand is that hedge funds really need information to do what they do. Most of them, I mean, hedge fund traders are trading in the market every day, and they're just hungry for information about these stocks so they can try and make bets that will be profitable. And so they're all out there trying to get good information about publicly traded companies, and they call that information edge. So if you have edge on a stock, it means you have figured something out, you've pieced something together, or done some little extra piece of research that maybe others in the market don't have, and that's going to give you a little advantage when you go to trade that stock. So that's your edge. So a group of traders at SEC Capital had a system for rating different kinds of information. There was a boss there who would teach this to his employees. There was white edge, which was publicly available, easy to find information, like a company's SEC filing. And frankly, that kind of information is not that valuable to a trader because it's already, priced into the stock, as they say. There's gray edge, which is a lot of what these people traffic in every day, frankly. I mean, it's just not clear what kind of information it is. I mean, it might be, a conversation you had with an executive at a company that was a little bit vague, but gave you an indication of something, and you might not be sure. Is it okay to trade on that? You might need to ask your legal counsel for advice. And then there was black edge, which was clearly inside information, such as confidential drug trial results before they are publicly released.
In my mind, and maybe I'm being cynical here, he was worth $9 or $10 billion at this time. He paid a total of $2 billion fines. If somebody told me that I could pay a 22% tax on getting a lot of illegal information, that's a good business strategy.
There are certainly people who see it that way, and I think that is why there is a sense of frustration about the story and the way it ended. And in a way, I think the Steve Cohen story is the story of our time because, as we've seen with the financial crisis as well, it seems extremely rare, or perhaps it might never happen, that very senior level people in the financial world face any kind of severe penalty for criminal activity that happens on their watch. I mean, there's been a real rise of sort of corporate impunity, many people believe. And even after the financial crisis, all the big banks and so on, where it seemed very clear to everyone watching that there was just rampant fraud going on and mismarking of mortgage bonds and all sorts of financial pain and suffering afterwards, but no one was even charged with anything at any senior level at any of those banks. They all dispensed with those problems through fines. And in those cases, they really are unfair because it's shareholders who are paying those fines. And in Steve Cohen's case, he just wrote a check, and he was the sole owner of SAC. SAC Capital stands for his initials, Stephen A. Cohen. And, he wrote a check, and he still had, $10 billion basically left afterwards. So a lot of people look at that and think that is not really justice. And meanwhile, the lower-level people, some of them ended up going to jail.
Yeah, it's kind of ugly. And I fault the Preet Bharara's group in part for not going after the mortgage folks more. I'll say another, to me, an indictment. He had a 30% compound growth rate for, some say, even up to 30 years. To me, mathematically alone, that's not really attainable unless you're cheating. And so they'll say there are so many folks in the organization and a few bad apples. But as Buffett will tell you and others, 5% of your trades determines basically your return, your alpha. So a lot of that gain could have come from illegal trading. Am I right or wrong?
Well, again, it's hard to know for sure. I mean, certainly many of SAC's competitors on Wall Street felt that way. They were very, many of them were kind of confused as to how the firm was able to generate these incredible double-digit returns year after year. In fact, by the time all of this sort of legal drama came to fruition, I think SAC had only had one down year in its entire existence, and that was 2008, when, of course, everybody had a really tough year. That was the height of the financial crisis.
You're listening to Business Talk with Jim Campbell over the Biz Talk Radio Network, 350 stations around the country. Go to biztalkradio.com to find the station nearest to you. Listen over the internet, access our podcasts. Go to campbellbiztalk.com to our website. We'll be back with more with Sheelah on the hunt for Stephen Cohen. And we're back with investigative reporter Sheelah Kolhatkar. Let me just ask you this. I don't know how much you know, but you talk about his background. What kind of a person is Steve Cohen? One thing bothers me, for example, he buys a $141 million painting, which of course also shows up the prosecutors at the same time. But also he's been fighting his first wife for years to give her basically nothing. Tell us a little bit about him, and he's a middle-class guy. Is this Revenge of the Nerd stuff?
Well, the hedge fund industry overall is a little bit the story of the Revenge of the Nerds, because a lot of them were started by people like Steve Cohen. He came from a modest background, a middle-class family in Great Neck. I do think, I have a sense from speaking to people close to him, that he felt a little envious of some of the wealth that he saw around him. The money was a little tight in his house, but he was really interested from an early age in becoming a Wall Street trader. He wanted to be rich, and he knew that early on. He went to Wharton, graduated in 1978, and took a job as a trader on an options desk at Gruntle and Company, which is a little brokerage firm in Lower Manhattan, and very quickly distinguished himself as a very talented, essentially a day trader, someone who could sit there, just look at the news, look at the market. They called him a tape reader.
Yeah.
So he would look at the orders coming in and out and just kind of go with his gut, and he was very, very good at this. And he launched SAC in 1992, and he really was an entrepreneur and a savvy businessman. I mean, he kind of figured out, this is before the hedge fund business had really grown up into the huge central industry that it is today. It was an entrepreneurial, kind of scrappy thing to do, to go out and open your own shop. But he wanted to be his own boss, and SAC was enormously successful for many years, just by having people there essentially mimic what Steve Cohen himself was doing. I mean, he would trade, and often his traders would just sort of ride along with him. And as the hedge fund industry matured and evolved, it became much harder to do that because there were so many other funds competing with you. The good ideas were all used up, so you had to just do more and more work to find profitable trades. And over time, he evolved his company, and he started hiring real experts in different industries so they could really study the companies they were investing in more closely. And, the SAC was enormously profitable for years and made Mr. Cohen one of the wealthiest people in the world.
And it looks from even in his first jobs at Gruntle, when he was, they thought he might have tipped his brother to the RCA NBC deal. He learned A, how to take the fifth, and B, how to have rumors around him. I will say, having been tough here, he's very civic-minded. He gives a lot of money in Greenwich, so we'd include that. Turning to the street a little bit, in this period before Preet Bharara stomped down on insider trading, was it systemic on Wall Street in the nature of steroids were in baseball?
Well, certainly the FBI agents who were investigating this heard that from people. And, there was this moment in the mid-2000s when a supervisor at the FBI's Manhattan office kind of said to one of his agents, listen, we need to kind of look into the hedge fund industry. We just don't know what's going on there. It was, this opaque world, very powerful. All the Wall Street banks and firms are sort of bending over backwards to get hedge fund business, but they're lightly regulated, and there just wasn't a lot of transparency about what they were doing and what they were investing in, how they were doing it. So the FBI started to look into it, and they heard the name SAC a lot. A lot of people were suspicious about how they were making so much money. And, of course, Cohen would argue that they came after him because he was successful, but certainly the government heard that there was suspicion around him. And as they pieced this all together, they did hear from witnesses in the investigation that, listen, once one hedge fund starts to, push the line, use inside information, everyone else has to do it as well. It was so competitive that any little advantage that one fund adopted quickly had to be taken up by everyone else. At least that was the perception among certain types of funds. And
all right, we're going to dive in now to some of this opaqueness that goes on. Rajaratnam, to me, kind of a minor league, Steve Cohen, who they went after first, and big mouth and wiretapped and everything, and they used RICO tactics, which they used against the mob. Steve didn't get caught with that up, was he? And he was wiretapped too. Where did he get this sixth sense? What's the difference between Rajaratnam and Cohen?
Well, it's interesting. They have very different personalities. I mean, my sense with Raj is that he really liked to brag all the time, and that is often an undoing of someone. I mean, he would just brag and boast about how plugged in he was and what good intel he had, and he frankly seems to me like he was much sloppier, and that is part of the reason they got him. I mean, I think it's exactly right that after they started to look at hedge funds, they decided they were going to apply the methods they'd used with the mob. Character I write about a lot in my book, B.J. Kang, an FBI agent, starts wiretapping all these hedge funds, and he's in there listening to them. And I think he was just shocked by how openly Raj was willing to share inside information with his sources, and he was paying people for it. And it was just stunning to the FBI. They were really surprised. And it extended it to all sorts of hedge funds. It seemed like a lot of them were doing this. Steve Cohen ran a tight ship. He was very careful. And the structure of SAC was also different. It didn't permit the same kind of just information flowing around that happened at Raj's hedge fund, for example. At SAC, there were groups of portfolio managers were in different groups with little teams working for them, and they were all competing with one another, and they were responsible for giving good trading ideas to their boss, Steve Cohen. He wanted to know what they knew, and he wanted to trade himself. He had his own book, as they say. And so he taught them to use a conviction rating. So when they would go to him with a good trading idea, they would say, well, I have a conviction of 8. I have a conviction of 9. That would reflect how sure they were or confident they were about the idea. And it does seem to have insulated him from what some of these guys were doing. And in some cases, the lower level analysts and so on were even concealing the source of their information. They wanted everyone to think they were just a genius, whereas really they were getting it, from some inside source. So that definitely helped Steve Cohen in the end.
All right, let's moving into that the information through channels. Michael Steinberg was a portfolio manager who was convicted at one point, but there were information, what they call this secondhand read, where quarterly earnings from Dell, for instance, would be leaked to somebody who would leak it to somebody else, who would leak it to somebody else, and then it would eventually get to Steinberg, and then it would eventually get to Steve Cohen. It seemed to me that everyone on this chain knew where the information was coming from, though.
Well, again, it depends on who you ask. Of course, it looked really bad because you would have a chain of 4 or 5 different analysts at different hedge funds passing this information like it was a precious pearl, from one to the other, and they would each trade on it and make money from it. So the logical question is, why would they do that if this is just perfectly normal information that anyone could get?
Now,
however,
we're down to the last 30 or 40 seconds. This when it gets to the say the Dell Quarterly, for instance, Steve's defense part of it was he was only reading 10% of his 1,000 emails a day. Is that credible given his voracious appetite for info, particularly this kind of info?
Well, the government was very skeptical of that explanation, but it did work in the end. They really could not prove he had read the email, so they were stuck having to charge his company instead of him.
Hey, you're listening to Business Talk with Jim Campbell. We'll have more on Steve Cohen and insider trading, and we're going to look into the Matthew Martoma story next. We're back with Sheelah Kolhatkar, the author of Black Edge, Inside Information, Dirty Money, and the Quest to Bring Down the Most Wanted Man on Wall Street. In this RICO-like, mob-like tactics, as they put this together, did they eventually go over the line? David Gannick's offices in Stanford were raided. He ran Level Global, a $4 billion fund. Then there ended up being the Newman decision, which is some of these where the information flow was deemed too far to be that you could attach it to them. Did they go overboard?
I think you could definitely make that argument that they took it too far, and they were, in the end, sort of slapped down by the appeals court in New York, which told them, listen, you guys were a little too aggressive, and you were kind of bending the rules to try and prosecute people. And the problem was when you have people who had received information third or fourth hand, in some cases, those people didn't really know enough about where it came from to be liable for insider trading. And as you described, yes, they did use some very strong-arm tactics at a few points in this, including raiding some hedge funds, literally storming in the middle of the day and taking out people's cell phones. And that led to the complete collapse of those funds because basically no investor could keep money in a fund that had been raided by the FBI, even if it was found later to have done nothing wrong. So the people involved in those raids who were affected are very angry, and I do understand why. I don't necessarily believe the government intended to do that, but I think that if you asked any of them privately, they would say that was a misjudgment for sure.
All right, let's go to Matthew Martoma. To me, Michael Steinberg and Matthew Martoma might be the two people that you could most closely link to giving information directly to Steve Cohen, neither of whom did that. Or flipped, I should say. Talk a little bit about what was essentially looks like institutionalized insider trading, which is these expert networks, which is where Martoma ended up getting information through.
Well, Martoma came to SAC, I believe, in 2006, just at a point when Steve Cohen was trying to hire more kind of Ivy League, really pedigreed analysts and traders, guys who had these really impressive backgrounds. During another era, they might have been working as medical doctors or doing something else. But, during the go-go hedge fund time, the best and the brightest were all flocking to hedge funds to do this, stock analysis work. So Matthew Martoma comes along, Ivy League background. He's an expert in biotech stocks. And he was very interested in tracking a drug trial being run by two pharmaceutical companies, Elan and Wyeth. And they were developing an Alzheimer's drug, and there was a sense that if this drug was successful, it would be enormously profitable because there was no existing cure or treatment for Alzheimer's disease. So a lot of Wall Street was watching this drug trial and trying to figure out how it was going to go, whether this drug would work or not. And the company's stocks were volatile and very linked to the success of this trial. So Martoma immediately just starts trying to do absolutely everything he possibly can to gain an edge in these stocks and in this drug trial. He just wants to do everything he can that might help him. And for a variety of reasons, this industry had sprung up to cater to hedge fund investors. It was called an expert networking industry. And these companies started up where they would offer to connect hedge fund investors and other investors with consultants who worked in different industries at different companies who could help educate the investors about their employers, their industries. And of course, when you explain this to a non-Wall Street person, it just sort of seems obvious that it's going to end up leading to inside information. But the people, it's like, how is that possibly valuable if they're not sharing confidential inside information? But the expert network consultants were told they were not supposed to share material non-public information. There are a whole bunch of rules. They had to sign things saying they knew that, but there was no one monitoring to make sure it didn't happen. So the FBI agents, like B.J. Kang and the other characters in my book, were sort of, they saw this and they said, well, wait a second, why are these hedge funds paying thousands of dollars to these people if they're not getting really good dirt out of them? And in the end, the government, alleged that Martoma, through one of these firms, had made contact with an Alzheimer's researcher who was helping to run the drug trial he was interested in. And over months and dozens and dozens of phone calls and meetings, was able to elicit inside information out of this doctor. And the doctor ended up cooperating with the government and testifying against Martoma. And there's a very dramatic scene that I sort of describe in the book where Martoma allegedly gets on an airplane, flies to the University of Michigan to visit the doctor, and looks at this secret presentation on his computer. And then he goes back home, There's a record of a phone call he made to Steve Cohen the next morning. And then on Monday morning, SAC Capital started liquidating its holdings in these drug stocks because Martoma had allegedly learned that this drug trial was going to fail. And in fact, it did fail. And a week later, when the news got out publicly, the stocks plummeted. And SAC was alleged to have made $275 million in avoided losses and profits.
And I think at one point, am I right, that they actually held a long position of $700 million to $1 billion in there? Is that right?
Yes, that's the incredible thing about this.
That's a lot of money.
Yes, they had a very large position, and in fact, it was a mostly unhedged position. So a lot of other people at SAC were worried about their exposure. I mean, it seemed a little risky to have such a huge long position in these drug stocks when everyone knew if this drug trial didn't work out the way Martoma hoped, they would just plunge.
It was more than concern, right? Weren't there other portfolio managers who were actually short at the same time, wondering why Steve was long at the same time?
Well,
the same firm.
There were other sort of healthcare analysts at the firm fighting with Steve Cohen and saying to him, "Listen, you should reduce this position. There's a lot of risk here." And Martoma would not share with his colleagues why he was so confident. And there was a lot of internal dissent because Steve Cohen was famous for, prudent risk management and having $1 billion long position that could decline by, 50% at the drop of a hat.
Wow.
It did not seem like a prudent risk manment strategy.
All right, let's explore Martoma because it seems to be an interesting guy. First, I guess he fainted on the lawn when that's what you were mentioning, I think, in Florida. But there's a history of character issues, right, at Harvard?
Well, yes. So this all came out during his trial, and it's frankly a little bit sad. But Martoma had grown up in Florida. His parents were Indian immigrants from India. By all accounts, it was a very hard-driving family where he was expected to achieve academically from an early age, and he did. He had really good grades. He was like a merit scholar. Eventually, he ended up at Harvard Law School. Very hard to get into, obviously. So there he is, and according to an investigation that Harvard ended up doing, he doctored his transcript to boost his grades as he was applying for a legal clerkship for the summer, and Harvard ended up expelling him. And he then ended up kind of covering this all up, and then he went off to Stanford Business School, and it seemed that Stanford was unaware of this whole backstory. There was this very dramatic moment during his trial because this was all secret. Nobody knew about this, and finally it burst out and it ended up getting filed as a sort of a motion in the trial, and it was on the front page of the New York Times business section during one of the first days of Martoma's trial. And, there was a lot of concern that it would bias the jury because it really made him seem like a very dishonest person. It looked so bad, and his parents were just so mortified by the whole thing. And it was just so sad, the whole story.
Sheelah, this is where I can't understand, that I know Rich Zabel couldn't understand. Here's a guy that can minimize his sentence, maybe get no sentence by directly implicating Steve Cohen, perhaps the only guy. Steve Cohen, meanwhile, has fired this guy already out of SAC. They called him a one-trick pony. Why wouldn't Martoma flip in your mind?
Well, that was one of the big mysteries in the whole case, because I think the government really expected that Martoma would flip and that they would be able to take testimony from Martoma to make a case against Steve Cohen himself. But Martoma shocked everybody by refusing to tell them anything. And he, of course, pleaded his innocence, but he really wouldn't talk to them or answer any questions or explain himself. And it was baffling because he really had no reason to be loyal to Steve Cohen on the surface. He had really a wonderful family, a loving wife, 3 small children who he was going to be separated from for a long time. He was facing a long sentence, possibly 10-plus years, just because of the magnitude of the crime involved. And, yeah, Steve Cohen had treated him badly. They could not figure it out. And to this day, it is a bit of a stubborn mystery. Obviously, there's all sorts of speculation about witness tampering and, that maybe he was afraid of Steve Cohen or maybe he was going to get paid something. There was no evidence of any of that.
Steve Cohen paid his law fees, legal fees, right?
Well, SAC did pay all of his legal fees and continues to do so, I believe. But that was a policy of SAC. But it was a very powerful tool because if you did not have a big hedge fund paying your defense fees, it could easily bankrupt you. I mean, I think even just one of these cases could easily run into the tens of millions of dollars.
Let me ask you about this theory that he just had a tremendous amount of pride and didn't want to admit to his father that this was true, for instance.
It's certainly possible. I mean, I think it would speak to some kind of personality disorder if you are willing to go to jail for 9 years and be away from your 3 small kids in order to preserve your pride that way. But, I mean, stranger things have happened.
Business Talk with Jim Campbell from our flagship stations, Yale Radio, WYBC, and WGCH Greenwich. A little bit of an after-action report in our final national segment. And we're back with New Yorker magazine staff reporter Sheelah Kolhatkar. Just finish off, obviously was devastating news for the family. What was Matthew Martoma's sentence and what's his status now?
Well, so he was sentenced to 9 years in prison, which is a pretty long sentence, and he's serving that sentence in Florida. But his case is on appeal, and in fact, there was a very intriguing development just in the last week. The appeals court has agreed to rehear his appeal argument, which is very rare. So there's a possibility he will get a new trial. We're waiting to see.
Oh, I hadn't heard that. All right, there's the old walks like a duck, quacks like a duck. Do you think that Steve Cohen should have faced personal criminal liability?
What do I think he should have? That's a tough question. On one level, the whole thing seems, when you look at it, very profoundly unfair. And as I said earlier, it's a story of our time of profound unfairness in our economy. At the same time, they really did not have the goods. And certainly from his perspective, if they didn't have it, why should he possibly go to jail for that? And it's partly the government's fault, too.
And let me ask about the government there. Did they become, they'd had such a huge winning streak, I think 89-0 or something. Did they become too risk averse and just so scared of losing that they wouldn't go for it? Well,
there are definitely people who believe that. I think it is a problem that they became a little bit enamored with the idea of just winning all the time. And Preet Bharara, who is the U.S. attorney in Manhattan leading many of these cases, he was getting so much attention in the press, and they were calling him the Sheriff of Wall Street, and he was doing these press conferences, and his face was on the cover of Time magazine. And I think, frankly, who wouldn't enjoy that a little bit? And the thought of taking a big risk on this case that may or may not work out well was not appealing, and that does affect their decisions when they're deciding which cases to pursue and who to go after. And there are many critics who believe that they continued with insider trading cases because they felt like a sure thing and neglected more complex and risky financial fraud cases that might not have led to a predictable positive outcome for them.
Now, we've had these rulings that have overturned some of these cases, the Newman ruling. David Gannick is suing. You just talked about the appeal that might be accepted. Now there's a lot of pressure with President Trump to scrap a lot of Dodd-Frank. Are the regulatory restrictions loosening such that we could be back to business as usual?
We now live in a time when most people in the United States are encouraged to put their money in the stock market for their retirement. We all have 401ks, and there are no more pensions. So we're all in there in the stock market. And there's all sorts of stuff going on that really undermines the integrity of the market. And it's very interesting to me now to see what Trump is doing because, of course, he seemed very kind of anti-Wall Street when he campaigned, but now he's installed, multiple Wall Street financiers from hedge fund world, private equity, Goldman Sachs executives to direct our policy, and they seem very intent on really dramatically rolling back regulation. And the last time that happened really was during the George Bush presidency, and there was a real deregulatory philosophy ruling. And the SEC, for one, was run by someone who thought the market could regulate itself, and the SEC was sort of discouraged from being aggressive. And during those years, we had the mortgage fraud bubble inflating, and we had a huge spread of insider trading among hedge funds. And then that ended with the financial crisis blowing up and all of these hedge fund cases. And I just think people should remember that and make it clear that we don't want to go back there.
We seem to have a short memory in this country generally. Now, of course, Steve Cohen is now running Point72 Asset Management, a family office, but there's a chance that fairly soon that he could go back to taking public money. Is that a good thing?
Well, I think it says a lot about the world. It seems to me that investors will return to him. I've heard this from potential investors or former investors. They're so desperate for a sure thing that I think many of them may well overlook what happened in the past and take his argument that, it was a few bad apples and put money with him again. And, I personally find that a little surprising, but he's taken a lot of steps to try and distance himself from the scandal and has tried to really tighten up his firm, improve compliance and all that. And we'll have to see if it worked.
And I think from our looking into it, they've been very sincere at what they've built in this new Point72. In an after-action, bigger picture thing, Warren Buffett, claims that hedge funds don't add any value; they just take a lot of fees out of things. Where are you on that big picture? Is Wall Street and hedge funds are they adding real value at the end of the day?
Well, I don't want to paint all hedge funds, obviously, with the same brush because there are thousands of them. However, they would all say, well, we add liquidity to the market. We help bring kind of transparency to prices in the market by doing all this research and trading stocks. And they do manage, in some cases, pension fund money of teachers and civil servants. However, I find it a little odd that we have decided as a society that these jobs are going to be the most highly compensated jobs in our economy. There's very, very little else you can do to make so much money so quickly. And, the top hedge fund managers on the list every year are making over $1 billion a year.
Is that more than you make at the New Yorker?
Yes. I think it's more than almost 99% of anyone in the world makes. And what is it that they're doing that is so valuable to our society that is worth $1 billion a year?
Is that also, could I draw the line about misallocating our top business school talent so much to Wall Street? You mentioned Martoma, for instance, could have been a doctor.
There's been an enormous flow of the best and brightest students out of top colleges and math and engineering programs and everything into hedge funds chasing this money. The funds hire relatively few people. Many of them are paying, different taxes from the rest of us who earn salaries. There's a real argument to be made. Many of them do give away money through pet charity projects, but really, as a whole, what are they contributing to the greater good, and what are they taking away? And
all right, as we get down to the end, we're going to talk about this later, but Herbalife was a alleged pyramid scheme that the FTC had a chance to take down. SAC was a hedge fund that the feds could have taken down. Neither of them ended up getting taken down, did they? Even though they looked obviously guilty.
I think it really just shows you that it's very hard. It's very hard to go after these really powerful entities for a variety of reasons. I think it helps explain why things seem so broken in Washington. Frankly, both of these stories.
Very interesting. And the book is mesmerizing. It's Black Edge, Inside Information, Dirty Money, and the Quest to Bring Down the Most Wanted Man on Wall Street. This has been Business Talk with Jim Campbell. Stay with us now. We're going to go into overtime. Sheilah's going to talk about a look she's just recently done into Herbalife, the alleged illegal pyramid scheme. Our next show, we turn to fiscal reform. Maya McGinnis, president of the Committee for Responsible Federal Budget. We'll talk about fundamental budget reform, and President Trump is presenting his budget right about now. Thanks to Sheelah Kolhatkar. Thanks to our national audience for listening. See everybody next Sunday on Business Talk with Jim Campbell. You're listening to Business Talk with Jim Campbell. This is segment 5 overtime. Sheelah Kolhatkar nicely agreeing to stay on. She has just written a fascinating article in the New Yorker magazine on Herbalife, which obviously involved not only a pyramid scheme, but another hedge fund that was trying to take it down. And before we jump into that, it just sticks in my mind that the feds have been unable to take down Steve Cohen, and they've tried everything they could, it seems. And would they be trying to play a little dirty through leaks, et cetera, providing source information to maybe convict him in the public eye if they weren't able to get him in the courtroom?
Well, there certainly were leaks going on during the sort of heightened period of this case, and just to name one example, the day when Michael Steinberg was arrested, who was Steve Cohen's very senior employee, Steinberg was arrested early in the morning. The FBI came to his apartment, took him away. There was a Wall Street Journal reporter who had been tipped off about it ahead of time, standing out on the street, recording the whole thing with her iPhone, which the Journal then posted on its website. So you can imagine that Mr. Steinberg was pretty upset and felt like his privacy had been violated, and this was controversial. There were tons of leaks like that. I don't know why they happened. Clearly, there were some people inside the government who felt that it would help their cause, perhaps. But there are people who are really mad about it, and I think they are justified. I mean, what the FBI does is supposed to be confidential.
Yeah, is it illegal?
In some cases, it is. And I think you're even seeing that right now in Washington. There are FBI leaks every single day about Trump and Russia.
Yeah.
And in some cases, those will end up getting investigated, and there could be prosecutions at the end.
Fascinating. Okay, we're going to turn to Herbalife. You've just written this article called "The World of Business: Shorting a Rainbow," and first explain to folks, I mean, there's companies like Amway that are considered legitimate multi-level marketing firms, and then there's these, in fact, you could almost say the business itself has an image of being a pyramid scheme, and the bottom guys fail at a huge rate. Tell us a little bit about that and then Herbalife.
Well, multi-level marketing is a very controversial sort of business, but it basically means that you're a company that sells products. Often they tend to be kind of health products, but it can be anything really. And but instead of selling them through stores or your website, you have armies of independent salespeople, just regular people who are selling them to their friends and their family. And the law around this area is a little murky, but in general, what's happening is a lot of those independent salespeople are trying to recruit other people they know to also become salespeople. So there's always this question of whether the company is selling actual products to people who want the products, or whether the company is really built on recruitment of wannabe salespeople who are spending their own money to try and become salespeople and losing that money, and then the money ostensibly flows up the pyramid to the people at the top who are making a profit from all the failures of the people below. And for it to really be a pyramid scheme, it has to be the sort of enterprise that will collapse if new people stop flowing in at the bottom, because there's no real retail demand for the product. It's just people trying to get into the business of getting rich, selling whatever product. So it's controversial.
And to bring this down to the level of how nefarious this impact is, there's huge pressure to recruit folks. A lot of them have been lower income people, Hispanic people. 90% or more fail. You have to have some sort of gap in your conscience to do this, don't you?
Well, that is certainly what the hedge fund I profile in the story thought. With Herbalife in particular, I should say about multi-level marketing companies, Amway is a good example. It's a huge company. In fact, Betsy DeVos, our new education secretary, is married to.
Oh, that's right.
Yeah, so she's entirely bankrolled by Amway profits.
And Avon too, right?
What's that?
Avon too, right? Aren't they?
Avon is also similar.
Yeah.
So some of them are considered more legitimate than others. The FTC is constantly shutting little ones down. But Herbalife, it was not entirely clear. Certainly Herbalife maintains that it does everything completely above board, and but the FTC, didn't necessarily agree with them. But so Herbalife sells nutritional products like weight loss shakes, protein bars, vitamins, that sort of thing, skincare products, and they do really focus a lot of their energy in the Spanish-speaking population. A lot of new immigrants, Latinos, poor people, frankly, and for years they would make a very aggressive pitch to people and say, you can get rich if you become an Herbalife salesperson, a distributor, you'd be called. And there was always this question about whether people were getting into that because they loved Herbalife products and they really just wanted to kind of buy them for themselves, or they were chasing these promises of riches and then trying to recruit more salespeople, and which is the only way you really make the big money at Herbalife. And the hedge fund that I profile concluded that this was sort of a fraudulent enterprise, and they wanted to expose it to the world.
And the product's overpriced, right? There's not a lot of science behind it. Is that the typical thing with these businesses?
Well, so Herbalife certainly employs many scientists, and I met some of them. And so they would say that their products are actually really high quality. But at certain points in the past, the company was accused of really misleading consumers about the quality of its products. So there's always a question mark about that. And they are expensive. And, you can go into a GNC store or Whole Foods store and buy a thing of protein powder and make shakes to lose weight at home. It's, relatively inexpensively. Herbalife products are really sold at a high premium. So they would say that it's because they're high-quality products. But I guess part of the way they're able to draw people into the network is by offering discounts. So if you sign up to become an Herbalife salesperson, you are offered a discount off this high price, and I think a lot of people, find that appealing.
Before we get into the hedge fund side of this, you traveled to Mexico, I think with the hedge fund guys, researcher on this. Talk about the nutrition clubs and what it's like on the ground.
So one of the strategies Herbalife employs to try and bring its products to new salespeople, consumers, all of it, is by encouraging people to open up what they call nutrition clubs. It's a very odd concept because it's not totally clear what they are. But basically, if you want to become an Herbalife business person, start your own business selling Herbalife stuff, the company will teach you how to rent a little storefront in a strip mall and set up a little counter and a blender, and you can serve shakes. But the thing is, you're not allowed to operate like a real retail outlet. So you can't have any advertising. You can't have a sign outside. You can't really advertise it to anyone. But people can come in through word of mouth, and for $5, taste a couple of Herbalife products. And the idea is you can hang out there and talk about, losing weight and maybe do a fitness class. But it's a very strange thing. And then, of course, a lot of people spend a lot of money trying to start these clubs.
Why aren't they allowed to use the name Herbalife even?
Well, so inside the club they can have Herbalife.
But I mean, the storefront, whatever, the thing that would be logical, you can't use the name.
I know, it's odd. No, and they all have green curtains covering the windows because they have to, for tax and other regulatory purposes, they have to make it clear that they're not a retail establishment. They're like a private club.
Jeez.
And that's why they cannot attract foot traffic with signage or branding outside.
Sounds like
they're all very strange.
They're set up to fail, the whole thing sounds like.
Well, I think there are some which are successful, but again, those are people who are kind of higher up the chain, and then there are many which are opened up by new people who come in later. And yes, I mean we were actually in New Mexico in Las Cruces, which is a fairly low-income city, very heavily Spanish-speaking population, and there were just dozens of these clubs which have been shuttered. And clearly, people were taking out loans to open these clubs, and then they just weren't working out.
It's just devastating. Okay, we're going to get in now to the war with Bill Ackman's hedge fund. But one irony I find of this is set up as you're going to be independent, you're going to be free to the recession, and the income inequality. Well, there's more income inequality in this than there is in the real world, right? Because it's like only 1% or less make any money.
Well, Herbalife, that's why I really thought this story was sort of like the American economy on a
steroids
micro scale. Yeah, because Herbalife was definitely using income inequality and the lack of job opportunities for many people, especially people without college degrees, to draw them in by promising them potential financial freedom and independence, and saying you haven't been to college, but you can come and make a really good living doing this, and you can advance and you can work hard and take your family on vacation to Disney World, something you never would be able to dream of doing. I mean, honestly, it made me sad to hear so many people get involved because they want a more flexible schedule so they can see their kids more. So Herbalife says, well, you can just work from home, work your own hours, and, they really thrive when there's a lack of good jobs around. I think something like Herbalife becomes more appealing.
Okay, Bill Ackman runs a hedge fund called Pershing. He saw this as an illegal scheme and he wanted to actually drive him out of business. talk about what was the guy thinking to put $1 billion bet that would require the government to take action, that the business would have to be shut down?
Well, so hedge funds have, in the past, played a really important role in exposing fraud in the market. And so that is, when we spoke about hedge funds earlier and what the benefits are, that is actually one benefit. Many hedge funds are incentivized to find a fraudulent company and then bet against it. So that is an important function, because otherwise we wouldn't necessarily know about these frauds till much later. In this case, they had various researchers. Again, they have all these really smart, Harvard graduates and so on working there, doing researching and working really hard. And they concluded that Herbalife was a pyramid scheme and was preying on people and causing all sorts of economic harm to these, Latino immigrants who were losing money trying to become Herbalife distributors. The company, by the way, totally disagrees with that characterization, and they say that people love Herbalife products, and that's why they buy them. And there's just a fundamental, they just deny all that. But
by the way, Sheelah, one of the things that I find very telling on whether they're guilty or not is the whole model has to be retail-oriented versus just distribution, right, to be legitimate. And somehow they say they never track where the sales go. Well,
that, of course, was such an odd thing because, we could get to that more when we get to the end of the story. But,
go ahead.
So this very powerful, kind of famous hedge fund manager has been very successful. Bill Ackman, he runs a fund called Pershing Square. I think now it's around $8 billion, but it's been above $10 billion at different points. He's having kind of a rough couple years right now.
Yes.
So he decides, okay, this is a fraud, and I am going to expose it. I'm going to short, we're going to short this company. We're going to then let the world know that it's a fraud. We're going to, lobby the government to investigate the company. We're going to go to our members of Congress, the FTC, whoever, the SEC. And then once everyone realizes what we have figured out, that it's a fraud, the company will go down, and we're going to make money, but we'll also help people by exposing this fraud. So, a lot of other investors had looked at this company for the similar reason and had kind of concluded that even if it was kind of a not totally above-board company, it would be too difficult to kind of do the work you needed to do to cause it to collapse or go down. I mean, it was just a daunting amount of work. The company was reporting $5 billion in sales. Huge company, has buildings all over Los Angeles. It's not just like a little shoddy company. It's like a huge corporation. And many people are long Herbalife shares and feel, very positively about the company. So it was not an easy thing to do and required a certain amount of kind of hubris to really tackle this. But they set up $1 billion short and then set about trying to publicize it. And this is something that you are legally allowed to do, even though it seems a little odd because they're benefiting from all this publicity. But, Bill Ackman's a very charismatic guy. He's comfortable going on TV. He made presentations and met with legislators. And eventually, the FTC decided to investigate Herbalife. And this was a real victory for Bill Ackman. Over many months, the FTC looked into it and ended up basically reaching a settlement with the company. The FTC accused the company of they didn't use the phrase pyramid scheme, but they really had a very harsh condemnation of the company and said that it was misleading people. It was promoting false promises of business opportunity. It had fraudulent advertising. They said the company would have to fundamentally restructure its business model and start operating legitimately, which I thought was a pretty damning statement from the FTC. And then they said, you're going to have to pay us $200 million, which we're going to use to compensate victims who've lost money. And you have to do all these things to change your business to operate legitimately. And what's been incredible about this whole story, so it seems like Bill Ackman was sort of vindicated by the FTC. And FTC seemed to agree with a lot of what he's been saying, but Herbalife's stock price has not really gone down that much. And it's been a real frustration for this hedge fund. And, they at one point they had lost, hundreds of millions of dollars because the stock price had gone up instead of down. And now they're still underwater. I mean, I think they shorted it in the 40s. I'm not sure exactly where it is, but it's been trading in the 50s. I mean, it's not at its high point or anything. But it's it's been an incredible frustration. And one hedge fund manager said to me, Bill Ackman's been right about everything except the stock.
Yeah,
and he just has not made the big profit that he was hoping to, at least not yet.
So, and the FTC essentially found it to be an unlawful business model. And is the problem that Ackman bet on rationality, both in the market and in Washington?
Well, he seemed to think that his calm, cool analysis and his kind of technocratic expertise and brilliance would overcome all this emotion about Herbalife. Like people, on the other side, you have all these people who love Herbalife because they think it's their ticket out of poverty. And I think he thought he could really explain rationally why they were incorrect, and they didn't want to hear it. And Herbalife certainly, still to this day maintains that that the FTC was actually wrong, and Bill Ackman was wrong. And one thing that was very odd about Herbalife's reaction was that they kept saying all along, people are not buying our products because they want to be Herbalife salespeople. They're buying them because they love them and they want to consume them. But then they admitted that they actually didn't really know who was buying their products and for what purpose. And there's a lot of pressure on salespeople to buy certain amount of product every month to qualify for their commissions from the company. So all these distributors are buying thousands of dollars of product every month to get their commission, and Herbalife is saying, well, all those purchases are consumers is buying it to use it, and but they didn't really know or have the data. And right now they're furiously trying to convert everybody over to being a real retail customer instead of these wannabe salespeople. And this is something they have to kind of do a lot of this by May. So we will see shortly.
Now, I'm told by, I've spoken with experts in the multi-level marketing field about this as we followed this, that the FTC felt very uncomfortable about having a hedge fund make a lot of money out of this, and that they, in a sense, viewed Ackman as a bad guy as well as Herbalife.
Well, certainly Ackman and hedge funds in general are very controversial. And, of course, there were people who said, what right does someone like Bill Ackman have, this extremely wealthy, kind of like well-dressed, slick guy? What right does he have to go out there bashing this company to make a buck? I mean, it did really bother some people. And there was a sense that the government's not going to do anything that seems like it's helpful to a rich hedge fund billionaire. Yeah. I mean, why would the government try and help him out?
But isn't that an indictment of Washington? Because if the business is an illegal business model and it's screwing lower income people, but they're not looking at it purely on that. They're taking in factors like we don't like Wall Street.
Of course, politics creeps into every decision in Washington, and this may be another example of that happening. And, it's not good. Does that lead to the best outcome for the market? No, probably not. But it is a reality. Everything is so political, and I'm sure they were worried about how it would look if they kind of did exactly what this hedge fund asked them to do.
Let me ask you this, to tie it back to insider trading. A lot of people say, insider trading is victimless. Nobody's really hurt. Now, in this scheme, people are really hurt. Do you and dreams are killed? Do you agree with that, or do you think insider trading is just as bad, or how do you weigh them?
Well, it's interesting. Insider trading, I don't think, is the worst crime in the world. I don't. However, if we want to just make insider trading legal and just say, okay, everyone can just buy the best information available, and like some people who have more money are going to have the better information, the rest of us will just have no clue. If we want to go that route, I think that's a conversation that we should have as a society, and then change our laws to reflect that.
Yeah, that again is like saying baseball should have continued to keep a blind eye on steroid taking. Do you think that...
It's just another advantage for people with resources.
Yeah, it's clearly
to get...
Clearly, should multi-level marketing firms be shut down? The general pyramid scheme deal, or not?
Well, I think that's a complicated question. I mean, again, there are so many of them, and they're all a little different from one another. I mean, on the surface, it seems odd to me that you would structure your company this way. Why not just go and sell your products like everyone else? I don't totally understand it. And certainly if you look at the numbers, many of them, yes, you have this handful of people at the top or the early salespeople who are just enriched enormously, and then other people losing money at the bottom. But I think there are some which are probably more legitimate than others. So it's hard to kind of paint them all with one brush. And there's a problem the FTC has as well. They're largely regulating this on a company-by-company basis. And
interesting.
It's interesting to note there are now in the Trump administration several multi-level marketing people in charge, including Trump himself, who was involved with two kind of failed multi-level marketing companies before he ran for president.
And who fit into the pyramid scheme, if you ask me.
Well, they were sanctioned by regulators, and did not seem to really do any good in the world and cause people to lose money. And then, of course, there's Trump University, which is a different sort of company, but a similar thing where people were just getting promised one thing and losing a lot of money, and there was a legal settlement with that. Ben Carson was involved in a multi-level marketing company, and then there's Betsy DeVos, and I think there are even a couple of others. So, the critics of this industry have been pushing for years for a very clear piece of legislation that makes it illegal to do this. And I think now in the new regime in Washington, it seems really unlikely that that is going to happen. I think the multi-level marketing industry is rejoicing about Trump being president because that is just going to fall to the bottom of the priority list, protecting people who are losing money on these.
Well, you do great work, and you take on tough, complicated cases, make them really fascinating. I want to thank Sheelah Kolhatkar for staying with us. That New Yorker article is The World of Business Shorting a Rainbow on Herbalife, and the book, again, is Black Edge, Inside Information, Dirty Money, and the Quest to Bring Down the Most Wanted Man on Wall Street. You've been listening to Business Talk with Jim Campbell. Thanks again to Sheelah of The New Yorker. Thanks to our loyal audience for staying with us. See everybody next week.